Hey guys, Daniel here. I thought I'd make this video to give you my thoughts on Alphabet stock. I do own Alphabet. It's the only Mag 7 company that I own. I bought it in 2022, I believe, or 2021. I can't remember. At about $90 a share, I think was my average price. So I got it at a very good price, and I continue to hold it. It's the only Mag 7 company that I really, really like and am enthusiastic about, despite the fact that I believe, as investors, our biggest advantage is going to be primarily in the small and micro and nano cap space. I saw Alphabet as a huge bargain at the time, given my projections for what I believe the business to be doing over the next few years. And I wanted to share my thoughts on its valuation currently. So for Alphabet, they do deliver about, let's just say, $70 billion a year in free cash flow on average. Now, when you factor in things like stock-based compensation, as well as the fact that they've been buying back shares, your per share calculation might be a little bit different. But I think for sustainable earning power purposes, saying it can do about 60 to $70 billion a year is, at least sustainably, I think is very accurate. If you look at different aspects of its business model with its advertising and its ability to basically ramp up its revenues to almost whatever it wants, it's really a money printer compared to some of the other Mag 7 businesses. But I think of the Mag 7 businesses, Alphabet is the one that I have the biggest confidence in, so it's the reason why it's the only one that I own. But talking about Alphabet specifically, with its $70 billion per year in free cash flow generation, when we're talking about valuation, what do I think the business is worth approximately? I'll go through my thought process on that. And typically when I do valuation, I think fair multiple, for the most part, for excellent businesses, is the best way to go about it. Fair multiple is basically saying, okay, what is its earnings power? What's a fair multiple to apply based off the characteristics of the business and its likely growth rate? For a business like Alphabet, for a business like Alphabet, which I really which I really like, looking at a $70 billion earning power, the question then becomes, what's a good multiple for a business like this? And generally, the biggest factor is going to be things like its growth rate. So how much is it likely to grow over the future? And that's very hard to narrow down and say precisely. But if you look at different analysts and its possible expansion in terms of its market, as well as its advertising revenues and its trajectory, saying it's likely to grow at somewhere between 10 and 15% per year in terms of its free cash over the next 5 to 10 years, I think is not unrealistic. So if we're assuming a growth of anywhere between 10 to 15%, which based off of analyst predictions is actually a little bit more conservative, I would say a fair multiple for a business like that would definitely be better than the market average. And we know historically the market average for a company is about 15. So if the average company has historically earned or been worth on average 15 times its earnings, what would a great business like Alphabet be worth? Some would say as high as double that, so maybe up to 30 times. Others would say 25 or 20. I find it very difficult, and Ben Graham did as well, if you read in Security Analysis, to value companies at more than about 20 times earnings. So I think it's very, very difficult to say, well, this is its earnings power, we should apply a multiple greater than 20. I almost would never do that. The highest multiple I would afford a company would be about 20. So if we do that, and we say, well, based off of its fair multiple, it's earning 70 billion per year, and we think that it's worth about up to 20 times, that would give us a fair value of about 1.4 trillion in terms of its market cap, right? So 1.4 trillion. If we look at the current market cap, of course, we're at almost 2.2 billion, so substantially above that. So at least on a first glance look, it does seem to be a little bit overvalued compared to our conservative valuation of 70 billion in earning power times a fair multiple of 20. And again, that fair multiple of 20 is pretty conservative. If you told me you think it's worth 30 times earnings, I would even say that maybe you're right based off the projected growth. The other thing is, it's not just about its free cash flow growth; it's also about its return on capital. So, what sort of return does it deliver on the capital that it reinvests back in the business? And historically, it's done about 25%. That is very high for a business whose cost of capital, you can argue, is anywhere between 7 and 10%, probably, I would say. So for a company like Alphabet, for a company like Google, to deliver such high returns on capital, you know, it must have some sort of competitive advantage, which if you know anything about the business model, it obviously does. So looking at this business, you know, and saying, well, it could, Alphabet could be worth up to 20 times earnings, and it does about $70 billion a year. It being worth 1.4 trillion is I think fairly conservative. The second way of looking at it is looking at, well, what sort of return can we expect from owning the company over the next, let's say, 10 years. And the simple way of doing that is looking at what my current free cash flow yield is on a per share basis, and add the growth rate to that, and then look at approximately what alternative investments are giving us. So the free cash flow yield currently on a share of Alphabet stock is about 3%. So what this is saying is right now we're getting a 3% yield up front. And the next part of this formula is basically what our anticipated growth rate is. And like we said, I believe that this is a business based off of its current economics and runway. I think it can grow at 10 to 15% per year conservatively over the next 5 to 10 years. And so if we just want to be conservative with it and we want to say, well, you know, 12.5% is the middle between 10 and 15%. Let's just say we estimate, well, it can grow at 12.5%, and we know that, or we believe that, because of where they stated they're planning on expanding their business and where they're planning on improving their margins and all those other things. Then saying that, you know, it'll grow at between 10 to 15 conservatively, and so we take the middle of that and 12.5. Again, these are just rough numbers. They're not perfect. That then gives us an estimated long-term rate of return of about 15.5%. So really it depends on your hurdle rate, because if you're saying, well, you know, if I buy Alphabet, I want to achieve a 20% annualized rate of return based off the current price and your limited free cash flow yield, you're unlikely to do that unless you believe a lot of growth is set to come, you know, down the road. And if you look at different analysts, like what they estimate, they're looking, you know, on a sort of annual basis, you know, very high growth rates going into next year and the year after. But again, analyst predictions, you know, I don't know how much you necessarily want to, how much weight you want to give them. Let's put it that way, because they tend to be off by quite a bit, quite often. But for a company like Google that is highly looked at, you know, maybe they'll be right. So we said, you know, based off of a fair multiple, it's probably worth about 1.4 trillion. Based off of a free cash flow yield plus growth, our long-term rate of return is probably going to be about 15.5% approximately. What that means to you depends really on your hurdle rate. The third method is, of course, looking at a sort of DCF and trying to figure out, well, you know, if we say that they're earning about $70 billion a year now, and they're likely to grow at 15% per year over the next 10 years, and then we have, you know, just basically terminal value, that again places the value at about 1.4 trillion, which is close to what we estimated using our simple fair multiplier strategy here. So in this video, you know, we looked at Alphabet. We came up with a conservative valuation of about 1.4 trillion based off of our understanding of the business, and we looked at what our long-term anticipated rate of return is going to be from owning the business, about 15.5% per year. What that means to you, again, will really depend on what your individual hurdle rate is. And using a DCF, we also came up with an approximate fair value of about 1.4 trillion as well. Compare this to the current market cap, it would seem as though Alphabet is overvalued at the current price. What that means to you, if you believe in valuation, really, well, yeah, I'll leave it up to you. In my opinion, it is overvalued, but so is most of the market. Probably compared to a lot of the other Mag 7 companies, it's more fairly valued, but we're definitely in a bull market right now, at least maybe at the end of it, maybe still at the beginning, who knows, there's no way to really predict these things, but based off of what it looks like, it seems as though Alphabet stock is overpriced. So that's my take. Thanks.